For a digital asset space that technologically changes so much over time, there's a remarkable stability if one opens up the quantitative financial analysis playbook and examines the space. Today, we're going to use that toolbox. I'm joined by Pierre Debru, who's head of quantitative research and multi-asset solutions at WisdomTree in Europe. Welcome back. Crypto Clarified, the show where we sit down and take a hard look at the ever-changing digital asset space. We also consider in this episode how it's remained stable in a few ways. It should be an excellent show. I am Benjamin Dean, Director in Digital Assets at WisdomTree. Before we start, US listeners, check out wisdomtreeprime.com on the Apple or Android app stores. Hit subscribe and share on Spotify, YouTube, or iTunes, and check me out on X, the Bird app at Benjamin Dean. Before we begin, shout out Sam and James in compliance, everyone's favorite part of the show. Before I begin, I need to state the following: to clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. All right, now on to the fun stuff. Let's cut to Pierre for the interview. Yeah, welcome to the show.
Welcome. Nice to be back.
Yeah, it's always a pleasure to have you here. And it's a kind of fortuitous time to have you on at the moment, given how busy this year has been in digital assets. For today's discussion, I thought we'd cover a few topics. Perhaps the first one we could talk about is some work that you and I did now 2 years ago. We released it. It was a white paper, a new asset class, exploring the digital asset ecosystem. Now, listeners, you can find that paper online at the WisdomTree website. We'll put the links into the show notes. But Pierre, that work that you and I got to do together, well, it was fascinating work. The piece that I took was kind of the history of the space, how it evolves, why it is what it is, and the taxonomy. But whenever I tell people about this white paper, I point at the chapter that you wrote at the end around quantitative methods. Now, for this space that we hear often, it's fast moving, it's fast changing. That's true. If you actually sit down and do kind of quantitative methods, though, you look at the data and analyze them, it's remarkable how little of our central theses from that paper have changed in 2 years. For the listener's benefit, I pass to you now to kind of run through how you view the space and kind of methods you used, the insights you found, and then we can check and see, are they still true? And if so, why?
Yeah, no, thanks, Ben. Yeah, it was very interesting work we did like 2 years ago, like you said, trying to really introduce this new asset class to investors that maybe were not too familiar with the space. And like you said, you wrote about the history of the space and how that history kind of created some kind of classification that you could use, similar to a sector classification for equities, and we also tried to use that paper to discuss and move on from what it is to how useful can it be for an investors from a portfolio construction point of view, right? From a strategic asset allocation, from a tactical asset allocation. And while the spaces continue to evolve, the technology continue to evolve, right? What's interesting, as you say, is that part around the role of digital assets in a portfolio, the allocation, and so on, that has not changed much. I'll just note, though, that when we wrote the paper, the reception we got was good, but people wanted to discuss more about the classification and the history of the space.
Yeah.
When the last few months with the team, we've been discussing more that allocation piece with clients. So it feels like the traditional asset management space has evolved itself, has moved on a little bit from what is this thing to how do I use this thing, right? And that's really interesting. And of course, the launch of the US spot Bitcoin ETF have been pivotal for that move, right? Like in some way, European investors they have had access to Bitcoin or Ethereum exchange traded product for years, but the fact that it is now approved in the US changed the mindset. I don't know, it triggered something, and so now we moved on from what is it to how do we use it. So that's really interesting. But like you said, when we discuss how do we use this thing, the discussion we have is basically the same as we would have had 2 or 3 years ago. The the generic investment case has not changed, and the way you would think about introducing a digital asset into an asset allocation have not changed either. So if you want, let's go through a little bit of this mindset that we put together into the paper about how to think about allocating. I think the first thing we discuss in the paper, and that maybe surprise sometimes investors, is to say that in some ways a neutral allocation to digital assets in a portfolio nowadays or 3 years ago, right? But let's say nowadays is not zero, right? If you look at the market portfolio, right? The portfolios that represent all of the liquid assets in the world, you realize that in fact, Bitcoin represents around 1.1%, let's say, of this market portfolio. In fact, if you look at the total market cap of digital assets, it is basically the same size as high yield bonds or inflation-linked bonds or emerging market small caps. It was the case already 2-3 years ago, right? But what that means is that if you are a purely passive investor, you have zero view in the market, you're just buying what's available to you, 1% in digital assets is your allocation, is a neutral position, right? And what does that mean is that it flips the mindset of investors, right? Like investors tend to think, or at least used to think 3 years ago, zero is a neutral position. So if I don't know too much and I'm not allocated, it's not a big deal, right?
Mhm.
And only people that were interested really were making that step to say, oh, maybe I'll invest. But the reality is that by not investing, you're taking basically a short position or at least an underweight. And that means that you're creating a huge cost of opportunity for yourself in the portfolio, right? And so we've been saying for 3 years, sometimes in the void of space, now a little bit less, with a little bit more reception from investors, that 1% is really the passive thing to do, and
Mhm.
that going below 1% is because you have a strong view, um, uh, if you want a real thesis of why digital assets should not be worth that much, right? Or you can go above 1% if you think they should be worth more. But if you don't really know, or if you haven't looked at the space enough, 1% should kind of be the default, right? And I think when we wrote this 3 years ago, it was a little bit new and
Mhm.
it was a little bit surprising to investors. It's interesting to see that it's still a little bit the case right now, but the reception is completely different. People were looking at us a little bit like we were crazy 3 years ago. Now,
Well,
a lot
to be
less.
fair, to be fair,
But
not you, but when I turn up with you, so
but now a lot less, right? So that's a nice change of pace. Um,
yeah.
so that I think that's the starting point of this part in the white paper to say, look, 1% is very much a passive thing to do. Zero is not. And then we looked at the reason why you would want to have 1%, right? And of
Mhm.
course, there is all of the story, if you want, that you wrote around the development of the space, the new technology, the adoption. And I don't know if you want to discuss this, but we were discussing how maybe 3 years ago, Bitcoin was still in the early adoption space, or at least at the end of the early adoption phase, and now it's not. It's moved on. But basically, all of this story about, okay, the impact that the technology can have on the world in the next 5 to 10 years, but more from an investment point of view, we were talking about the fact that there is a huge asymmetry in investing in such an early stage asset, because of course the maximum loss you can make is 100%, when the
Mm-hmm.
maximum gain is not capped. It can be 200, 300, 400, 500, like we've seen, right?
Mm-hmm.
So the asymmetry is very large. The growth opportunity is massive. Again, something that's quite surprising to people is when we say, okay, yes, of course, it's a very volatile space and you can make money, you can lose money. But
Yes.
if you ask, okay, let's have a look at the last 12 years calendar performance, right? Calendar year performance. Let's look at the different asset class. How does digital assets compare? When we say, look, out of the last 12 years, Bitcoin was the best asset out of like 9 of those 12 years. So
Mm-hmm.
3 out of 4 years. People are quite surprised because people expect half, right? It's very natural. I think there is a bit of a cognitive bias to think if it's volatile, it's half, it's half up, half down.
Mm-hmm.
But again, it's asymmetric. And so in fact, it's 3 up, 1 down, right? And so when you say it like this, that in fact you may outperform everything 3 years out of 4, and then there is 1 year out of 4 where you're going to underperform everything, maybe. At least that's what history tell us. That's not the same analysis you do in terms of like a risk reward, right? 3 to 1 versus 2 to 2.
Mm.
So that's also something, again, in the investment case that's really important. And I think the main thing, because of course the growth is really important and the asymmetry and so on, but maybe the thing that speaks the most to a multi-asset manager is the decorrelation. When we
Mm-hmm.
did the paper, we looked at the last 10 years, we looked at correlation with all the asset class available, and you realize that Bitcoin or even all digital assets, they're extremely decorrelated. They're in fact more decorrelated than what we think are strong diversifiers already, like gold or commodities, this type of assets that we think are strong diversifiers. Crypto assets are even stronger, right? What we have been trying to show as well more recently is that that has not changed. If you do the correlation matrix last 10 years, and if you do it last 2 years, it's basically the same. It moved
Uh-huh.
1 or 2%, right? So instead of being 25% correlation with equities, it's going to be 26, but basically didn't move. And that's interesting because if we think about the last 2 years, right, there is this feeling that all all cyclical or risky assets have moved together, right? 2022 was bad, 2023 was good, which in the big scheme of things, if you look very large period, that's true. But if you look at weekly or daily correlation, but even weekly, right, that correlation does not get greater in the last 2 years. So that's really important because when you look at correlation inside the portfolio, what's also very important is those, I won't say micro move, but like weekly move. And here the decorrelation is still very strong. And so again, you have the asymmetry, you have the growth potential. 3 out of 4 years, Bitcoin has outperformed, and you have the decorrelation that remains decorrelated. All of this makes for a strong investment case, and it's too bad we can't do this because I love blind tests, right? Like when you have two glass, we don't tell you what it is. One of them is Pepsi, one of them is cola, right? Is Coca, right? And you're
Yep.
supposed to guess, and people sometimes and they get it right or wrong, whatever. If you were not to say is digital assets, right? And you were to say these are the characteristics of this asset class,
Mm-hmm.
I think it would be a no-brainer that you want to invest. Not 20% of your portfolio, right? Obviously, the volatility is still high and the risk is still there. But
Yes.
1%, 2%, it would be a complete no-brainer. But as soon as you say it's digital assets, there is a bit of a switch that comes up, and a lot of people say, I've read too much negative things about those things in the last 5, 6 years to be completely comfortable. But on the face of it, all of the characteristics are very strong, and it makes a lot of sense. 1%.
So many ideas packed into everything you've just said and the paper and everything we've learned. And let's cover a couple of them because I've had the pleasure of working with you on it on this journey. and I've remarked a few things that you've shown me over the years, and I've had to learn, which may be interesting to the listeners. The first one is the passive one. You know, it's an active decision. First, you already said that one. I like, especially with the quantitative methods, right? We're removing the emotion from it.
Mm.
Now, with the crypto people, you know, the fanatical crypto people, and then you've got, like you say, the press, and it's like people doing silly things, and it's bad, right? And there's plenty of bad stuff that happens. So let's take the emotion out of it. I like your one with the Coca-Cola versus Pepsi. You know, I'm not telling you which one. Let's see how you behave. The other one I liked that you said to me before is it's almost a conviction play, right? You just say you don't overtrade. Yes, it's volatile, relatively speaking. So you basically just step back and say, what's my thesis here? Somebody said this to me a few years ago. They said, oh, Nvidia's down, you know, S&P 500 is also down, Nasdaq's down. But they said, listen, we think the world is going to be more digital. We're not changing the thesis. So we're buying Nvidia. Whether the drawdown, the world moves on, and then they wake up 4 years later, and Nvidia has also been a good performance. Now, this is the point where I say to Sam and James in compliance, past performance is no indication of future results. But you've pointed out to me that most people would be better just setting and forgetting. You got a thesis. Here's what you think, Sam. I'm going to set it purely passively, and I'm not touching it. And we see what happens, right? And it turns out that would have been a really effective approach. The last one I'll bring up, because we've had so many of these discussions, you brought up diversification and correlation. You have pointed out, like, nobody argues with the about other things in correlation, but this one they love to zoom in on. Correlations are unstable, they can change over time. But if you go and crunch the numbers, like you said, sure, in certain periods of time, correlations might change, but that's the same as any other asset or asset class, right?
Yeah.
The
I mean, on
volatility.
this, we have less of a pushback now that we went through 2022 and bonds turned positively correlated to equity massively. So clearly, it shows that all the assets we know, even the assets that have been over for 100 years, the correlation is not stable. And yes,
Mhm.
over the last 30 years, correlation bond equities are negative, and it's a nice way to do some diversification, at least in the last 30 years, but not all the time. And so
Mhm.
it's a lot less of a counter argument now for digital assets to say, oh, but if I look this 2 weeks, it was correlated. Yes, fine. Sometimes it is correlated. But over the bigger, longer terms window, it is not, and that's still true. So yes, it's funny enough, like 2022 helped us on this side, so it's less of a pushback now.
Yeah. There's also another dynamic that you've pointed out in the past, which is, you know, what does the growth potential have to be to justify a position in a portfolio?
Hmm.
You've also pointed out that over time, and we'll use one example, Bitcoin, um, return profile on it over time narrows as it kind of, I would say, as it goes along the adoption curve.
Hmm.
You might use a different term. But that asymmetric upside, while it still exists, is shrinking as the space matures and we go through this adoption curve process. Do you still hold that view, which is it
Yeah,
only needs to return 7% to justify a position? And do you agree as well that, like, we could expect in the future maybe that the asymmetry side of it may deteriorate for the more established things, not the newer things?
yeah. So I mean, for sure, as an asset matures, you're going to expect its features to change, right? Like as
Mhm.
digital assets matures, you would, and you're right to point out, Bitcoin being the most mature, it's going to happen way before the other one. But let's talk about Bitcoin. As it matures, you would expect volatility to come down, you expect
Mhm.
correlation to go up, and you would expect the growth potential to go down as well, right? Now we are talking in um, not even in years, in like decades type thing, right? Like
Mhm.
when is Bitcoin going to have 30% or 25% of volatility? Probably it's going to take a while. But for sure, the direction is going to be that way. And we see it a little bit in the volatility. The volatility is a little bit lower now than it was a few years back, but
Mhm.
slowly, right? Now, so in terms of is it an asymmetric assets? Is it a decorrelated assets? For sure, and it's going to me, it's going to be the case for quite a long time, but it's going to degrade as it gets more adopted, as it gets more into everyone's portfolios and so on, right? But still, again, we're talking quite long term here. What you're pointing out, though, is quite interesting, is to say, okay, we all know if you look back, Bitcoin is up 100% per year for the last 10 years, right?
Mm-hmm.
Now, what that means is that if you put it into a portfolio historically, it's going to improve the performance. I mean, it's not magic, right? If you add an asset that is doubling every year, even with the volatility it has, you are expecting better returns. It's logical, right? But if you look forward and you start to ask your question a bit differently, the question is not going to be if Bitcoin does again 100% per year for the next 10 years, should I have it? Because again, the answer is going to be yes. This is not really a question. The question is more, how much does Bitcoin needs to do in terms of returns so that it's worth having, right?
Mm-hmm.
And that's a very different question that yields a very, very different answer. And of course, the answer is going to depend of how fast the volatility comes down and how fast the correlation goes up. But even taking into account that correlation is going to be up a bit and volatility is going to be down a bit, or maybe we say volatility is not going to come down at all, you realize you don't need 100% a year. You need a few percent more than equity, right? So if you think equities are going to do 6 or 7% in the next 10 years per year, right, which is usually where people put equities. I mean, I don't want to discuss if it's 5 or 8, it doesn't really matter. If Bitcoin do equity plus 2 or 3, that's enough, right? To make it worth it in the portfolio because of the asymmetry and because of the decorrelation, right? And I think that's very interesting because that's not the same bar at all, right? Like if the pushback is adoption is happening, but I don't think Bitcoin can do 100% a year for the next 10 years, I'm not going to push back much. Maybe you're right. I don't know. But can it do equity plus 2 or 3 over the next 10 years? I think is a very low bar in many ways, right? Because there is still a lot of runway before we have a basically fully mature asset in front of us, right? And so that's a very different question to me. And that frames the question for investors in a very different light because it's not about it really needs to be a super growthy assets for it to be worth it. It's more about it just need to be an okay asset to be worth it, right? And therefore, the question is not anymore about should you have it, but what is the cost of not having it, right?
Okay.
Because if it is worth having with a relatively low bar, the low bar being that the correlation remains basically similar to what it has been the last 10 years, what it has been the last 2 years, and the return is just equity plus 2, right? If at this stage it's already fine to have it, it doesn't cost you anything, right? Then the real question is, but if it does 157% again this year like it did last year, what am I losing, right?
Mm-hmm.
Because you're not taking risk to having it, and or not that much risk. And if you don't take that much risk to having it, then other people are going to have it. And that means that you yourself not having it, you're potentially facing a huge cost of opportunity, right? Like if you think about a 1% allocation of Bitcoin in a multi-asset portfolio, right? Last year, it would have created around 160 bips of performance, right? 1% time 157% of performance.
Mm-hmm.
Let's simplify and say it's 160, right?
Sure.
If you think about from the point of view of a multi-asset manager and its peer group, right? How each multi-asset manager is comparing itself with all of the multi-asset manager in their market, 1.6% is a huge number, right? They're spending those investors are spending the whole year competing, trying to find an edge, maybe taking an overweight US, an underweight US, going a longer duration, shorter duration, right? To get a few bips better than your competitors. And here you would have left 160 bips on the table, right?
Mhm.
That's, I think, the way to think about it is about the cost of opportunity. If
Okay.
in fact the bar in terms of it not being detrimental is not that high.
Okay. Let's add let's add one more thought onto this. Um, as if there's none. We could talk all day. Uh, so uh, in crypto land, people argue like which one is the best one. It's a bit like is Nintendo better than Sega? And it gets like
Yeah, it shows you're old to say that.
there are heretics, and no, we're not doing that. And the other one is people used to say to me, well, if it's open source software and anyone can fork it, there's no moat, so
Mm,
that one could be gone and obsolete. And then some of the stuff just hasn't taken off, to be fair. The one that I like there is you say, all right, again, we're just going to use the numbers, and I'm going to strip all the emotion out of it, and I'm going to say there is this ecosystem. I don't know who's going to win.
mm,
Someone might win. Uh, I'll try not to mix the thoughts up here. So what you do is you just buy everything and you rebalance it over time. And then as the winners win, you get them. The losers lose, you cut them, right?
mm.
You've said to me before, in fact, the analogy of a dot-com bust and allocations to technology essentially over the last 20 years.
Mm.
If you sit there and say, I don't like Google, I don't like it. So you miss it, right? Or you go and buy all of it and you say, there's going to be pets.com in there. There's going to be pets.com and a bunch of other losers, right? But at least I have Google and Amazon and Apple. Can you talk a little bit or elaborate a bit on your thoughts there for the listeners? Because that point also has stuck with me. And I watched the crypto space as they're arguing about, I don't like Solana. And Solana has beaten everything last year. So where do
Yeah.
you stand on that?
So I think there is multiple aspects of this.
Okay.
The simple answer, and I always like to come back to this passive investors that doesn't know anything.
Okay.
Um, for that investors, investing into everything is a logical choice, right? That's why
Mm-hmm.
what we call passive investment is so successful. That's why Vanguard or iShares are so successful, is because you can't get it really wrong, right? You follow what the market is saying. It's a sum of everyone's thinking, right? So you buy everything, um, you hold on to it, and therefore you're going to have the winners in. You're going to obviously have the losers as well. But in investment, again, there is a huge asymmetry. There is a winner takes all approach. And I think in digital assets, it's going to be even stronger because of this network effect where you're going to have a strong winners and their moat is going to be this network effect, right? And so you're going to have some coins or some digital assets, whatever we want to call them, that are going to lose 100%, but some of them, they're going to do 10x, 100x, right? And so honestly, if you could buy the full thing, that's probably the logical choice because it's very, very hard to know who is going to win, right?
Mm-hmm.
Now, in digital assets and in investment, there is huge, huge um, impediment to that strategy, right? It's not possible basically to buy everything um,
Yep.
for reason of operational feasibility, right? Like if you want to buy a regulated asset, the list gets down extremely fast, right? In the US, it gets down to one. So that's Bitcoin. That's it. If you're happy to take futures, and obviously that's a bit different, maybe you get two in the US, right? In in Europe, it's a little bit more open, but it's not above 2025, right? So
Mhm.
quite quite concentrated. Um, so this passive idea is a little bit constrained operationally right now, but
Okay.
in my view, that's where we are going, right? At one point, we are going to have something that will be called I don't know, crypto 100 or crypto 500, and most people who just want to take the 1%, right, will buy that. They will have everything, and they will benefit from the growth of the space, right? Um, if you bought the S&P 500 in the 90s, you would have benefited from the internet growth, right? Um, so that's one way. Now, because operationally right now we are constrained, we can't just buy everything. There is a
Mm.
question about what we do. Um, and clearly there is going to be a bias towards the large caps, right? Bias because operationally that's the easiest to do, but also I strongly disagree with the fact that because there is a code base, it can be replaced easily, right?
Mm.
Um, those at the end of the day, these assets they're very resilient on network effect. They're basically
Mhm.
all of it is network effect in many ways. So the moat are in fact extremely strong, right? Like
Huh.
for someone to come and remove Bitcoin and doing basically the same thing, right? So to replace Bitcoin, I can't even imagine how much uh, it would take. Like it's so embedded. It's like the network effect is so strong. So the advantage of having something which have very strong moats in many ways is that the large cap is a relatively safe bet
Okay.
because it's going to take a very long time for them to die. They're not going to go to zero very quickly. So
Mhm.
so by just rebalancing the biggest one over time is a relatively good way to stay on top of things because the ordering in some way is not going to change like extremely fast at the top, right? Bitcoin is the biggest for ever, basically. Ethereum has been second for a very long time. And so the fact that it's that ordering and not their value in total, but the ordering is quite sticky, makes it
Mhm.
quite a good strategy, I think, to just buy those mega ones, those large caps, let's say, and to roll them. And if there is a new one that is really getting bigger, and Solana could be one that gets into the top three, top four, then you add it. And if something comes out, then you remove it. But I think you could have this passive investment by looking at really the top ones.
Okay. Got it. There's an adjacent idea, and I think we'll try and close up on this one because we've covered so much terrain today. And it's linked to the volatility piece, it's linked to a portfolio allocation piece, and it's linked to drawdowns.
Hmm.
Um, as part of your analysis, you looked at another thing with rebalancing. So you have these 3 out of 4 years historically where you get this outsized return, and then you have these drawdowns, 80, 60, 50. In a multi-asset portfolio, then essentially what you do is you rebalance your allocations and you're trying to cut the downside, so the drawdowns, and then you're trying to expose yourself to the upside if in the future the cycle repeats itself, which it historically has and is doing again, right?
Hmm.
You just briefly cover that piece there, and because I think it's informative and it was not obvious to me, but given the quantitative approach, it was obvious to you.
Yeah, I think it's in some way risk management, right?
Okay.
Um, but it's risk management squared in many ways with digital assets, which is when someone does a 60-40 portfolio, right? The idea is to diversify your risk, and because equity and fixed income they move relatively slowly. I mean, if we compare to digital assets, you can rebalance quarterly, or you can even rebalance semi-annually in some way. You can have an outlook only every 6 months or every 3 months. It's fine, right? The risk during the period where you're not rebalancing is going to remain quite stable. When the volatility increase of the asset you're adding to the portfolio, the rebalancing frequency becomes critical because we are saying, okay, 1% of Bitcoin is the neutral position. It is where the market is right now. And so let's say that the neutral, if you invest 1%, let's say November 2022, right? by the time you turn around in January, so barely 3 months later, you may have 2% of Bitcoin in your portfolio instead of 1. And so now your risk is twice, right? And doubling the risk is not negligible. And so that's why the rebalancing frequency becomes important. And what you want to do is rebalance more frequently because it allows you to keep the risk way more constant, right?
Mhm.
And it allows you to basically also capture some of the upside as basically realize the gain you're making as the asset goes up. So I think it's a fair point to say you need to rebalance relatively frequently because if you don't, then the risk that you are allocating to digital asset is going to move quite a lot. And if you rebalance, let's say only quarterly or let's say semi-annually, you're not going to have 1% in your portfolio. You're going to have between 0.2 and 4%, right? And then the timing of the rebalancing is going to be extremely critical to your performance because if you rebalance just before a drawdown, that's good. If you rebalance, if you don't rebalance just before the drawdown and you have 3 or 4% of digital asset and then you have the drawdown, then you're going to lose way more. So it creates a lot of path dependency at the end of the day, right? So frequent rebalancing for very volatile asset is really important. And that's something that we talk a lot about with investors because what's very unusual is that usually the most volatile assets that people have in their portfolio are not daily marked, right? If you think about private equities, venture capital fund, they are extremely volatile, as we know, but you
Yep.
get a valuation point every 3 months, right? So
Yes.
it doesn't feel very volatile. And you can't really rebalance because anyway the liquidity of the thing is extremely bad. But here you have something that is at the same time very volatile and open 24/7 all the time, and you see it, right? And that's a bit jarring, I think, because it's unusual. And so you need to remember to rebalance because you
Mhm.
can, right? Like I think
Yes.
in venture capital or in private equity, you should also rebalance, but operationally you can't. So it's a mute point. In digital asset, you can. So you should. And that's an important thing, is that because it allows you to control the risk. More important than the return or everything, you rebalance frequently because it allows you to control the risk to the level you're comfortable with.
I love the kind of logical rigor to it, but also, kind of it's acknowledging that, as you said, it can be a bit jarring. Most people aren't used to this, but if you sit down and think strategically about it, you use some of the tools out of the well-developed risk management toolbox. It is kind of tractable. But hey, you need to think very deeply about what you're doing. So yeah, you manage that risk. It's come a long day from. It's a long time since what they call in this space hodl. Just buy it and don't sell it, right? Hodl. So don't overtrade, right? That's been one strategy we've joked about for years, and it's what the other one is. Dollar cost averaging. Uh, take the timing piece out of the equation and just do it on a certain frequency. Set it, forget it.
Yeah,
Um,
I mean, frequent rebalancing is in some way dollar averaging
yeah.
in a different way, like, but it is. The risk with HODL, right, is that, and some of some people in crypto are going to have this issue now, is that it's just if you are right and you're buying the right asset and it go up, it is more and more of your portfolio if you never sell, right? And so you started, you said, you know what, I'll put 1%, but now 10 years on, it may be 50% of your total wealth, right?
Mm-hmm.
Like if you've been early in Bitcoin. And does it make sense to now have your current portfolio be 50% in Bitcoin? In my view, no, right? Like from an asset allocation, if you sit down today and you say, would you buy 50% of Bitcoin? You would not. So take the win and put it somewhere else, right?
Yeah. Yes. And well done. but think.
Yeah, exactly. Exactly. You did well. Very nice. But yeah, you can diversify the wealth now.
Excellent. Excellent. Well, that was great. Thanks so much for taking the time to talk to us. I'm looking forward to the next time we have you on the show because it's always refreshing to hear these thoughts. And it's amazing how timeless all of those insights were. I hope next time when we speak again, we can sit here and say the same thing.
For
But the
sure.
future's uncertain, it's turbulent. So I guess we'll see how it plays out. But if you've got 50% allocation, Pierre says, think. Cool. Well, thank you again, Pierre. I hope you enjoyed joining us today.
Thank you. It was my pleasure.
Pierre Debru from WisdomTree Europe. Hope you enjoyed the show. For US listeners, wisdomtreeprime.com. Check it out, Apple, Android app stores. Come find me on the Bird app. Come find me at Benjamin Dean. I'll be around. And thank you again for listening. I'm looking forward to joining us for the next episode.